I thought I'd start today's video off quickly. What you're going to learn in this video is how you get screwed in the world of trading. It's a video unlike anything you've probably seen in the industry. Everybody talks about how wonderful the profits are, how the gains are insanely high, and you can make consistent profits all the time and take prop firm withdrawals, and everything is rainbows and sunshine. What I want to talk about today specifically is where things can go wrong and where things do go wrong. See, the world of trading is actually not all rainbows and butterflies. And the sooner that you know that, realize it, and understand it, the sooner you can learn how to deal with the potential risks and problems and have a game plan going into it that boosts your confidence. I want to show you on the screen here some of the accounts that I'm running personally, because one of the questions I get all the time in the comments and the questions that I get in direct messages and everything else is, where's all the proof of what you're doing and that it works? So here are 6 different accounts verified by myFXbook that have been running for different periods of time. And one of the things you guys should know, if you've watched this channel and you've seen some of the content that we've been putting out there, is that this isn't a one-trick pony. This isn't like what you see on Telegram with, these EA providers that have those social media accounts. By the way, they come and go. They're on a rotating basis. Like in 3 months from now, that account that you're following today probably will evaporate because all the accounts will be blown, and then they'll start a new account somewhere else under a different name, and all of a sudden magically show overfit backtest results and history and all of this crazy stuff to make you feel like, oh, you finally found the magic tool. It's going to make you a bunch of money in the markets. The reality with trading is, whether you're doing it manually or through automation, you have to be involved with it to a degree that's going to enable you to know what's going on, how to change things when it goes wrong, and have game plans for both when things are going well and when things aren't going so well. So some of these accounts on the screen that I'm going to show you, like this one's been running since November of 2023. You can see the growth curve here. You can see drawdown 7% in that time period. Pretty slow and steady gains in this account. Now keep in mind, everything is relative to the account size that you're actually going to be trading these accounts on. If you see 7% drawdown, you can actually see this happen in a single time period here, sometime in April of 2025, whereas the rest of the period, there wasn't really a lot of drawdown on this account. So if you would have started trading this exact account in December of 2023, you would have had a really nice ride for a very long time. And this drawdown actually wouldn't seem that significant, because relative to the gains that you had made on that account, it really wouldn't have pulled you down back below where you even started from. Like, you never would have been risking your initial capital that you deposited into this account. However, for somebody that would have started this same exact account, but they started trading in March of 2025, well, they might have experienced a lot more pain in that drawdown, right? So always keep in mind when you're looking at whether it's our myFXbook or really any other myFXbook that you're going to be shoved in this industry as you get content thrown at you from different providers that are doing different things. It's all relative to your own risk appetite, and it's all relative to the timing with which you entered or exited or developed the strategies that you're going to be deploying onto the market. So here's an example too of a more short-term one. This account, one that I'm running that specifically is trading with the trend of minor pairs across a wide array of different pairs. And you can kind of see the month-over-month profits here. As I modify, I push the risk in some months and I pull it back in others, just as I'm seeing things be successful or not. I'm also re-optimizing all these accounts on a regular basis. So the way they traded in January isn't the same as the way that they're trading now, because you've constantly got to be keeping up in line with market conditions. Here's a gold trend set that's been running since, let's see, what is this, December of 2023. You can see the trajectory here. It's up 57%. In that time frame, there was a bit of drawdown here, again, June of 2025. And you can go and plug in, like, what are the geopolitical things that were happening in June? I don't remember off the top of my head, but the Trump administration obviously has pulled a lot of volatility into the markets this year, particularly around gold. And we've seen some of the accounts that historically had hardly any drawdown all of a sudden moving into drawdown. So we re-optimize those. We re-optimize them and then push them forward on the market. And you can see since then it's been very, very consistent. Once again, we're realigned. So that brings me to my first point of where things can go wrong in trading, and particularly automated trading, right? So let's move into the whiteboard. Let's tactically talk about where do things go wrong? Things go wrong in a number of different ways. Number one, large drawdown, right? And that can create an emotional response. You can see the drawdown on your account. It can cause you to make decisions that otherwise you would never make in a logical framework, right? I mean, essentially, if we dive into this like almost immediately, let's go a little deeper on this, right? This is true of anything in life, guys, too. Your brain operates in a couple of different modes here. So you can either be operating in the green, you can be operating in the yellow, you can be operating in the red, or you can be operating in what they call the white. And I'll color it with black just for contrast so you can see, but let's call that the white, right? Those are the 4 zones that you can operate in your brain. So let's call these the operating zones, right? The op zones. This is doesn't only apply to trading, by the way, but we're gonna talk about it in the context of trading today. In the green zone, this is where you're making your best decisions. This is your best decision making, right? This is an area where you are operating from a state of logic, and you're in the green when everything is aligned. Your psychology is aligned. You slept well last night. You've been eating well, for example, right? You're rested. There's no other stressors in the back of your mind or your subconscious that are causing you to make bad decisions. Okay, once stress starts to enter and introduce itself into somebody who's operating in the green, it slides you down into the yellow, right? And when you're in the yellow, this is when you start to waver. You're sort of wavering. There's an opportunity here anytime that you're in the yellow, and you can slide back and forth between the green and yellow, or you can start to slide into the red. So in the yellow zone, let's talk about trading specifically, right? If we go back to an account like this gold trend account that we're looking at, that's got this long-term history. If you would have started this account and you kept the money and you kept reinvesting the money back into the account, and you were on this growth trajectory, generally speaking, you're in the green mentally with this account for a very long period of time. Now, when you see this yellow line here, which is indicating some equity drawdown, right, at this point, and the drawdown views inside of myFX book aren't great. Let's try to pull them up and see. Okay, so let's say this was a live funds account, right? Is 4% drawdown on a 100K live account, even if it's a cent account, it's $1,000. Is that really going to scare you and pull you into the yellow? Maybe, maybe not. Depends on your own psychology. It depends on how firm you are in your green. It also depends on your preparation. Like, what were you expecting out of this account? Were you expecting it to always be at 1% drawdown? Because 4% would be 4x of your expectations, right? But if you had proper expectations, I would say none of this would bother you. And by the time you got here and saw 10% drawdown in June, you would have gained so much profit over the previous period that I don't think that this drawdown really should have stressed you out and applied any stress to the situation. However, if you would have just started the account here, a couple weeks later, you're seeing 10% drawdown on an account, and you just put $1,000 or $100,000 into an account, and it's now drawn down way more than you expected it to. Well, that's likely to pull you into this yellow zone, right? And then this is where your decision-making framework starts to fall off, right? The goal when you're in the yellow should be always to get back to the green before making any decisions. So let's talk about that a little bit more detail here. Anytime you're in the yellow, you should only have one goal. You have one goal, and that is get back to green. How do you get back to the green? You have to slow down. You have to pull yourself away from the account. Stop checking the account. This is, you'll know you're in the yellow when you're constantly checking the account, when you're looking at it multiple times a day, seeing where it's at. You got into automated trading so you don't have to check your account 100 times a day. If you find yourself checking the account constantly, if you find yourself opening up your VPS and trying to see, are things set up properly, or everything okay, you're likely in the yellow and you're headed towards the red. Now let's start talking about what the red zone is. So what does the red zone look like? So the green zone looks like, calm, logical. The yellow looks like stressed and anxious, right? Those are your first real, right? Now the red zone, this is when we actually start, this is bad action. We're not wavering anymore. We're actually taking action in the red zone that is significantly hurting ourselves or hurting our own accounts. So an example of that would be when this thing goes into drawdown at 10%, do I all of a sudden start making changes to the way the EA is taking trades? Do I close the position for a loss and throw a different master account at that, copying into this slave account to see if, maybe that will fix things? Or do I increase my lot size so that the positions that are being entered into in the future have more profit to recover some losses that I've had before, right? Those are spiraling decisions. Those are not logical. These are illogical decisions that are being made and happening. And then that actually will eventually push you down all the way into the white zone. And now the white zone is where you have this is like no control. Like you've basically lost all control of decision making. Your emotions are through the roof. You're seeing red. And that's typically where people who are frustrated, they'll leave like a 1-star review on Trustpilot, or they'll go into chats and just hammer away at oh, you said this thing was going to do X, Y, and Z in it. And then that's where you see total implosion. So if you can be aware of the states of mind that are possible to be in, right? It's okay that sometimes you're going to be frustrated by what the markets are doing to you. And the markets are going to humble you and you're going to have losses. You're going to lose funded accounts. Guaranteed. I 100% assure you, you will lose multiple funded accounts between now and whenever your last trade is that you take in your entire life. The question is then, how do we stay in the green more often than staying in the yellow and the red? And how do we never get to the white, right? Is really what you want to prevent from ever having happened, right? I said earlier that the green, when you're in the green, this is where you're operating from a place of health, right? You slept well, you ate well, you have proper expectations. This is super important. Proper expectations above everything else will keep you in the green longer than anything else, right? If I go into a situation and I know that there's a possibility that it's not going to play out the way that I want it to play out, and that there is a possibility that I could lose the money that I'm investing in the markets, then when the loss happens, it's going to be a lot easier for me to deal with, and it's going to maybe pull me lightly into the yellow, but it's not going to keep me there. I'm generally going to stay in the green, right? Your decision-making framework, right? And I talked about this in Instagram stories recently, where I actually had an account, was in a bit of drawdown. The markets kind of turned on me this way. I was in long positions as the markets were going up, and then it sort of just turned. And I was at a point where I was at my 28 days that I needed, and I was up close to 5%. And if this drawdown kept going down, I was going to lose the 5%, which means I couldn't take my withdrawal until things reversed back up, and then I could finally take my withdrawal again. In my mind, I was actually moving. I could feel this happening, actually. I was moving from green. I was moving down into the yellow, because in my mind, I was saying, well, I should just cut this for a loss right now. Let's cut this trade for a loss. And I'm still above 5% profit. I can take my withdrawal. We'll figure this out later, which, by the way, isn't a terrible decision. I'm not saying that's the wrong decision, but the reason that concept entered my mind was because I was in the yellow. I was operating from a state of emotion. I was operating off of FOMO and fear as opposed to operating off of pure logic. So I had to slow down. I had to slow down and stop. I put my phone away. I put a poll on Instagram, actually. And the funny thing about the poll, actually, is ultimately what ended up being the quote right decision, because at the end of the day, what happened was the markets did actually reverse. The markets reversed back up, and I ended up cutting for a profit somewhere, and then the account was up over 5%, and I was good to make a withdrawal, right? So the markets did reverse, and it wasn't even a ton of drawdown that I was in. It was very light. I mean, that's a very conservative set file that I'm running on that particular account. When I polled the Instagram community, everybody, it was like 80-20%, if I remember the split correctly, said to hold the trade and let it play out and wait until it closes and then move to withdrawal after that. That's because nobody that I was polling was at all emotionally invested in that trade. When you're not emotionally invested, when you have zero emotional investment, it is so much easier to stay in the green, right? When there's no emotional investment, the move from green to yellow, and then from yellow to red, and then eventually to white. Let's just talk about these, right? These moves, the catalyst for these moves is emotion. Emotion is what is the boat that carries you from one color to the next. Without emotion, you stay in the green, and life is good. So when I poll a community and I say, hey, what you guys do in this situation? What I get is extremely logical from the green responses. And it was really interesting to see that, because when you go into the community and you see new traders in our community, I don't know that they actually would have made that same decision if it were their money on the line. It's so much harder to make those decisions when you're emotional, right? So that's the key thing. So if you feel yourself in the yellow, how do you pull yourself away from the emotion in order to slide back into the green? And that's when you need to make the decision. Don't make the decision while in the yellow. Definitely don't make decisions in the red. And in white, you don't have any control over what you're doing anyways. You're too late, right? So only make decisions when you're in the green. Now, when you are in the green, you have this decision-making framework that you can follow, right? So if you imagine a road this way, and then you've got option A and option B, sometimes you have a C. Let's just say you have option B and A here. If you're the black line and you're standing here and this is the decision point, you have to decide, am I going to go this way or am I going to go this way? What you need to do is mentally in your head, walk forward as far as you can see in both directions. And when you get to the stopping point where it's as far as you can go, check in with yourself and think, would I be okay if X scenario? And then would I be okay if Y scenario, right? So what I mean by that is, what are the pros and cons of both decisions? Decision one is close my account now, take a loss, and get a withdrawal. Now, if I do that, will I be happy with the withdrawal? Yes, I will. Will I be upset that I left money on the table? Maybe, maybe not. Depends on the amounts. On the flip side, if I let it play out, and what's the worst case scenario that can happen if I let it play out? It blows my account. Maybe I breach the drawdown. In that particular example, that's not where we were. I was so far. I think I was at like 1% drawdown, and I have 10% allowable drawdown on that account. So like nowhere even close to that happening. So to me, there really was no downside. The downside was, well, I just have to wait a little longer for the position to play out. And then you look at the historical data of the account and you say, well, has it ever drawn down this much before? Yes, it has. What happened when it drew down this much before? Well, it recovered and it profited every single time without very much bleeding at all. And then the last question you ask yourself is, does this behavior resemble behavior that I've seen in this account before? And the answer was yes. It wasn't abnormal behavior. It just happens sometimes. This account goes into a little bit of drawdown like that and then eventually recovers. If the trades look different, if the volume of trades were different, if I was rapidly adding positions and I wasn't used to seeing that, or it was pushing into massive drawdown in areas I'd never seen before, then I would be more on the spectrum of, yeah, this is potentially going somewhere. It's possible that this strategy was in line with market conditions. Now all of a sudden it's not. Things have changed. The sentiment has changed. So the fundamentals of this algorithm are no longer sound and I need to exit this position. But none of that was happening. When I was in the green, I was able to see none of that's happening. This is just status quo normal. The only variable here that's different between now and any other time I've traded this account is the fact that I want to click the withdrawal button. That was the only variable, which is an emotional FOMO-based response and not a justification to intervene or interfere with the algorithm that's making the decisions. Let the algorithm do the work. And ultimately I did. It was the right decision and I was able to make the profits on that account. Okay, so that covers the point one. Like what could go wrong? Well, you could see larger than expected drawdown. To summarize, right? When that happens, understand, are you operating from green, yellow, or red? If you're operating from the white, you won't know it until after the fact. So it is what it is. Try to learn. Hopefully you can recognize way before you get there so you can pull yourself back the other direction. Understand if you're operating from the green, yellow, or red. And if you're operating from the yellow or red, find a way to remove your emotions and slow your thinking and push yourself into logic, right? You can do that by taking a walk. You can do that by playing with your kids. You can do that by watching a TV show that you like, something that disassociates you from the current moment, pull you into green. Then when you're in the green, engage your decision-making framework and make a decision. So that's how to handle the first way that you get screwed in trading, not just automated trading, all trading, right? The second way you get screwed in trading, let's talk about that. Prop firm rules and not understanding them. Let's just say prop firms in general. You can get screwed a lot of ways with prop firms, right? Not understanding the rules, read the rules. And after you're done reading the rules, read the rules again and ask questions about the rules, right? Check the T's and C's. Always check the T's and C's because they bury things in the T's and C's. Should I give you an example? Let's go to Funding Pips. Check out Funding Pips. They have this, 0-step 100K. This is an instant funding account on 100K. Maximum loss 5%, maximum daily loss 3%, consistency on rewards 15%, which by the way, nobody knows what that means when you first read it, right? What does that actually mean? Okay, here we go. Terms of use. Let's take a look at what's actually going on here. Here's where all the actual rules are. They pretend like these rules are for you. These rules are for them, right? So that they can not go bankrupt. For example, here. Okay, so here we are in the 0 step. This is their instant funded trading behavior, trading rules. Okay, 5% trailing loss limit. Notice how they define it as a trailing loss limit here, but when they're trying to sell it to you, it's just a loss limit. It's just a maximum loss. They don't say that specifically until you actually go off the page where you buy from and go in here. So that's the first point of deception. Second point of deception is, by the way, if you don't know what trailing loss is, I did a whole video on what trailing drawdown is. Watch that video. It explains it all. Actually goes through some of this as well. So the other one, 15% consistency score. You need to meet the 15% consistency score. Okay, what the hell does that mean? Well, they still don't tell you. So you have to go a level deeper to even understand what this means, right? Okay, maximum 1% risk. Can't exceed 1% your account size on your P&L, or the account will be closed. Not just the position's closed, the whole account's closed. So you've now breached. Okay, so this daily loss of 3% and this max loss of 5%, you can't risk more than 1% on any given trade, actually. Again, you might breach that if you didn't read through the T's and C's carefully. Minimum profitable days. You must achieve at least 7 minimal profitable days. A minimum profitable day is only counted if the day's profit is at least 0.25% of the balance. 7 days of profit, 0.25% profit on each of those days. So first of all, that means you need to make roughly like 2%. Bi-weekly reward with 95% split. Cool, that's easy. 15% consistency. What does that mean? Oh, this is a 7 profitable days. Okay, fine. 3% safety cushion. Check this out. The first 3% profit generated on the master account cannot be requested as a reward and acts as a safety cushion to protect your account from hitting the 3% daily loss limit by requesting a reward. In other words, because you have 5% trailing drawdown and a 3% loss, the first 3% you make, you actually have to, you can't withdraw that. You have to keep that as a quote safety cushion, because if you were to withdraw it, because of the trailing drawdown, you would basically breach the account anyways by taking the money out of the account. Okay, so you have to have a 3% safety cushion. Biggest loss cannot exceed biggest win. Okay, so your largest win has to be bigger than your largest loss. Like, okay, that's just random, but I think we can all manage that, whatever, but just an extra way to get breached, and or just like something to happen on the account. And it's just another thing to think about actually too in general. The more that I think about that rule, you'd have to set your stop loss at a point that's always less than your take profit on any given trade, which means you can't be trading something that's higher probability with lower reward, like a 0.5 to 1 reward risk. You have to actually have a risk reward that's above 1 to 1 at all times. Anyways, we don't have to continue down this thing, but the point is that if you would have just read this and then purchased the challenge, there are so many intricacies to these rules that you'd have just been unaware of. So the second way people get screwed in trading is by prop firms and their rules, right? Read the rules, read them again, read the T's and C's, ask questions, right? You have to do these things. You have to fundamentally understand what you're getting yourself into. Even FTMO these days has a consistency measure. Now they're less strict about it, and I think they just hold it in their back pocket so that they don't get screwed on a crazy upside trade that somebody makes. But they do have a score that tells you how consistent your trading is, and if you breach it, they don't pay you, right? So you just have to be careful with the prop firms and make sure you're reading your rules and fundamentally understanding the rules so you don't get breached by something that you just didn't know about. Okay, and the number 3 area where traders get screwed is copying instead of learning. Yeah, I see this all the time. I see Telegram channels. Maybe I'll pull one up. Found one recently. These people had taken our EA and then were pretending like it was their own, and then they were selling copy trading off it, or selling signals off of it, basically. All right, so here's an example of a Telegram channel that they're just posting every single day. Today's profit $4,000. Today's profit $6,000. Today's profit $800. And they're showing these videos, right? And it's got like an AI voiceover. It's not even a real person. First of all, you don't even know that these are real. You don't know that these are real accounts. These could be demo accounts. It could be fake money. It could be overfit results. It could be simulated entries. None of it looks real, right? On top of that, what they're asking you to do is take this so-called proven strategy and put it onto your account, being completely blind to how, why, or when these trades are being entered. So someday along the line, these accounts are going to blow. Your account's going to blow because you have no control over why or when these things are entering trades, and they've overfit a strategy that might work over a 30, 60, 90-day period. And this is why they have so many different like names for the bots. They have different Telegram channels. They have backup Instagrams, backup TikToks, backup Facebooks, because they know that their shit's going to blow up one day. And then eventually they're going to have to swap names or swap what they're offering. Okay, so the biggest way that people get screwed in this industry is that they think that there's some silver bullet EA, and this is what EA's, like the reputation of EAs in the market is. It's this tool that like you just copy and you pay once for, you pay a bunch of money for it, right, up front, and then it's just going to make you some return on the other end, despite you even knowing what the hell is going on, right? And a lot of people start this way. A lot of people start this way because they see, okay, automated trading makes sense. This person's come up with an algorithm that works. Let me just buy it, put it on my account. Not realizing, by the way, that if that bot was back tested on IC markets, for example, and you put yours on PU Prime or Owanda or something else, those servers are completely different. And the back test from server A has completely invalidated the use of it on server B. It doesn't work because the data streams, data feeds are completely different, right? You can't use them for prop firm capital because you get breached for copy trading, or at least you'll risk it, and the risk of these bots that are out there is too high anyways to put onto a prop firm account, and you can't control how it's trading, right? So if you have an EA, for example, where you can actually modify the entry points and the exits and the lot sizes, and you can set things like maximal daily loss, or you can set things like profit target for the day, even those crazy rules I was showing you with funding pips inside of Banker EA, you can modify the inputs to respond to those rules and actually perform within the given conditions of that prop firm account, right? But if you're just pulling an off-the-shelf EA, something like this, that's just telling you that they're guaranteeing you profits off of like some crazy magic fairy dust, like you're going to get screwed and you're going to call it a scam. And I got to tell you, it's more you than them because you got to do your due diligence on these things. You have to understand that if it's too good to be true, it's not true. It's broken, right? And this time and time again, we see this. Beyond all of that, maybe somebody does have a magic EA that you can just buy off the shelf and it's going to make you a bunch of money into the future. If you're watching this video, if you're scrolling YouTube learning about trading, you're not here to learn how to copy somebody else's work. You're here to learn a fundamental strategy that you can carry with you your entire life and you can use and leverage to earn income and buy back freedom. That's why you're here, right? So don't fall for the trap of taking shortcuts because they will burn you in the long run. Whether now, a few months from now, it could be a couple of years from now, but you will get burned by those shortcuts. Don't take the shortcuts. If you're somebody who has a ton of money and you're building wealth, you're expanding your retirement accounts, you're looking for passive investments and you want to put that money into managed account, that's one thing, right? A diversified managed account. But that's not the same as buying an off-the-shelf EA and turning it on against all of your cash and just hoping that it works the way that it's been working in the Telegram channel that you've been following, right? So you are either on that end of the spectrum and you're looking for wealth creation and growth underlying, at which point there is a proper path for that through managed trading accounts, which a lot of them are done through algorithms, right? Or you're the other side of the coin and you are a professional trader or aspiring to be professional trader, and you cannot make it in this game by taking other people's EAs and bots and work and just copying it or taking signals. If you really want to be a professional trader and you want to be sustainable in the long term, you have to gain control and gain education on what you're doing and constantly be evolving, not just your algorithms that need to evolve, but your own psychology, your own trading, your own training, your own mindset needs to evolve as well. Okay. So, I covered a few fundamental ways where I see a lot of traders get screwed in the markets. And if you watch this channel, check out the other videos on the channel where we showcase how our software and our tools are built for the class of people that's looking to actually take ownership of how they trade and why they trade and when they trade and gain an actual skill fundamentally that's going to help them into the future, right? We teach about back testing properly. We teach about diversifying your strategies. We talk about a tool that we have that enables you to have hundreds of different bots on a single account, all trading in different ways with different levels of risk, so that the combined collective effort of those is making 3, 4, 5% a month while the risk stays low, right? As you see by some of the results that we've shown on MyFX book today of our own personal accounts, our members in our community are seeing those results as well. So if you're interested in learning more, subscribe to the YouTube channel, check out all the other videos, check us out at team-pow.com. You can put in an application to join our community. You can watch the videos that we have available. We'd love to have you in. We also have offers coming soon with our partner brokers, where if you put live funds as a first-time deposit into a brokerage of one of our partners, we offer trading insurance, which is insane. I don't think there's really offers like this out there, where if you join our community and you use our tools, your downside risk is covered through trading insurance. As long as you use one of our partner brokers, or basically what we're doing is taking our affiliate commission and we're offering it back to you as insurance against any losses so that you can trade risk-free and keep yourself in the green, right? Because you're not worried about losing your money, you get to keep yourself on the green, make logical decisions, gain your confidence of our tools. By the way, we're not really worried about paying out the insurance because we know what's going to happen is if you follow the process, use it properly, you're going to see results, right? Like so many of our members have. So there's just so many things, so many ways to reduce some of these ways of getting screwed that we offer to our members. So click the link in the description, put in an application to join, chat with us on WhatsApp. You can chat with us over email, Instagram. We're all over. Put a comment on this video and we'd be happy to help you out with your trading. But otherwise, thanks so much for watching this session. Keep an eye out for the upcoming videos. Check our channel for more videos like this if you enjoyed it. Reach out to us with questions and we'll see you in the next one.